What if you could control a $10,000 investment with just $100 of your own money? Sounds like a dream come true, right? This is essentially what leverage offers in the world of trading and investing. Leverage allows you to amplify your potential gains. But here's the surprising part. It also amplifies your potential losses. Many people think of leverage as a way to boost their returns, and in a sense, they're not wrong. However, the reality is that leverage is a double-edged sword. It can indeed magnify your profits, but it can also wipe out your entire portfolio if things don't go as planned. The concept of using borrowed money to increase potential returns might seem straightforward, but the mechanics behind it are often misunderstood. And here's the crucial part. Understanding how leverage truly works is key to avoiding the dangers that come with it. So, let's break it down and explore what leverage really means and why it's considered so dangerous. What if using leverage in trading is like holding a magnifying glass over your investments, amplifying both the sunlight of gains and the flames of losses? Most people think leverage is simply about borrowing money to buy more assets, but that's only half the story. Leverage is a double-edged sword that can multiply your returns, but can also cut deep into your capital. And here's the surprising part. It's not just about how much you borrow, but also about the hidden mechanics of margin calls and liquidation. Think of it like a thermostat for your account. When your losses reach a certain temperature, the thermostat triggers a margin call, demanding you either add more funds or sell some of your assets to cool things down. If you can't meet the margin call, your broker may liquidate your positions, often at the worst possible time, causing even greater losses. This is why understanding leverage is crucial. It's not just a tool for making bigger bets, but a complex system that can quickly turn against you if you're not careful. By grasping how leverage really works, you'll be better equipped to navigate the risks and avoid the pitfalls that can lead to financial disaster. So, let's dive deeper into the world of leverage and explore how it can both empower and endanger your investments. Vocabulary: liquidity, margin, volatility, amplifier. What if you've heard that with the right risk management strategies, you can tame the beast that is leverage, making it a safe and powerful tool for growing your wealth? Many believe this to be true, and it's understandable why. After all, having a plan in place to limit your potential losses sounds like a recipe for success. But here's the surprising part. Even with the best-laid plans, leverage introduces a layer of unpredictability that can lead to catastrophic losses. Think of it like flying an airplane. You can have the best navigation system, the most experienced pilot, and a detailed flight plan, but if you're flying in turbulent weather, there's always a chance something can go terribly wrong. And with leverage, that turbulence is the market itself, which can be inherently unpredictable. The issue is that when you're using leverage, a small change in a market can result in a much larger change in your portfolio. And if that change is against you, it can be devastating. For example, if you're using 10x leverage and the market moves just 10% against you, you could lose your entire investment. And that's not something that any amount of risk management can completely protect against. So, it's essential to understand why leverage is not just a matter of having the right strategy, but also about understanding the underlying mechanics of the market and the unpredictability that comes with it. Vocabulary: turbulence, unpredictability, catastrophic, leverage, navigation. What happens when a large number of traders start using leverage in a market, and how does it affect the overall volatility of the market? At first glance, it might seem like a small amount of borrowing wouldn't make a significant difference, but the reality is quite the opposite. As more traders use leverage, market movements become more exaggerated, kind of like a row of dominoes. When one falls, it triggers a chain reaction. Here's the part most people don't know. When traders use leverage, they're essentially amplifying their market exposure, which means even small price movements can lead to large gains or losses. And here's the surprising part. These amplified losses can trigger something called a margin call, where the trader is forced to sell some of their assets to cover their debt. Now, when many traders are using leverage and the market starts to move against them, a feedback loop is created. Price swings trigger more margin calls, leading to a cascade of sell-offs, which in turn amplifies the market movement even further. This can quickly spiral out of control, creating a perfect storm that can crash an entire market. It's a bit like a snowball rolling down a hill. gaining size and speed as it goes. And it's essential to understand this mechanism to grasp the true dangers of leverage. By recognizing how leverage impacts market volatility, we can better appreciate the risks involved and make more informed decisions. Vocabulary: volatility, leverage, margin, cascade, amplifying. What happens when traders use too much leverage and the market turns against them? Can the entire financial system be at risk? To understand this, let's consider a simple analogy. Imagine you're buying a house with a mortgage, where the bank lends you most of the money, and you put down a small down payment. This is similar to using leverage in trading, where you're controlling a large position with a small amount of capital. Now, if the housing market crashes and the value of your house drops, you might owe more on the mortgage than the house is worth. And if you can't pay, the bank takes a loss. In trading, this can happen incredibly fast, with traders being forced to sell their positions at huge losses, causing a cascade effect that can lead to market crashes. And here's the surprising part. It's not just individual traders who are at risk, but also the entire financial system. Because when many traders use high leverage, it can create a web of interconnected risks that can bring down even the strongest institutions. For example, in 2008, the excessive use of leverage by banks and other financial institutions contributed to the global financial crisis, and it's estimated that the total losses were in the trillions of dollars. Understanding the dangers of leverage is crucial for navigating today's markets. And it's not just about personal risk, but also about the broader economic implications. By recognizing the potential consequences of leverage, we can better appreciate the importance of responsible trading practices and the need for robust risk management systems. So, let's take a closer look at how leverage can impact the financial system as a whole, and what this means for traders and investors. Vocabulary: volatility, liquidity, margin, systemic. So, what does leverage really mean? It means that with great power comes great danger, and understanding this mechanism is key to making informed decisions in the markets. Imagine you have a powerful tool, like a pair of giant tweezers. These tweezers can pick up tiny objects with incredible precision, but if they slip or you apply too much force, the consequences can be severe. That's what leverage does in trading. It magnifies your potential gains and losses to an extreme degree. Leverage allows you to control a large position with only a small amount of money. For example, let's say you want to trade $10,000 worth of Bitcoin, BTC. With 110 leverage, you could theoretically control that entire $10,000 position with just $1,000. That's like having 10 pairs of super tweezers instead of one. But remember, this magnification works both ways. If your trade goes in the right direction, you can make huge profits. But if it goes wrong, those losses can be catastrophic. It's like trying to balance a tiny butterfly on a needle. Any little disturbance could send it crashing down. So why is leverage dangerous? Because it turns small fluctuations in the market into big swings in your account. A 1% move in BTC with 10x leverage means you could lose or gain 10%. That's a lot of risk for what seems like only a small initial investment. Understanding this, you can see why many traders caution against using too much leverage. It's not just about making a few quick profits. It's about protecting your capital and maintaining control over your trades. If you want to learn more about how markets really work, consider subscribing for more in-depth explanations. Knowledge is the best tool you have in this game. You don't need super tweezers. You need clear vision to see through the noise.